Google stock has just split 20 for 1. So if you're like the average person, you probably think, great, it's a lot cheaper now. Hold your horses. It is not cheaper. Just because you're paying less per share doesn't make it a better deal. I remember back in high school, I was a sophomore in Algebra 2 Trig. A kid in the class raised his hand, and this was back in the dot-com era. Everything was going high flying. So the kid in the class asked the teacher, who was also the track coach at my high school, and said, do you own Nike stock? He said, no, I don't. It's too expensive. It's $50 a share. Remember even back then thinking, that's how I know I'm a value investor now, because I look at things back then, I'm thinking to myself, that doesn't make any sense. Berkshire Hathaway is $37,000 a share. Nike's $50. Berkshire Hathaway isn't 1,000 times or 800 times more expensive than Nike. It's what's behind it. So let me explain that further. When you have a company, if you're new to this channel, I'm Paul. I teach value investing. I also make it my goal in life to call out all the financial scam artists out there. This moron right here, he's now releasing notes about how he's Warren Buffett and to be calm. This is after he recommended all of his investors to invest in stocks that have gone down 75 to 100%. Nice job, moron. Anyhow, when it comes to stock splits, here is what's happening. Google stock, we'll call it, was around $2,000 a share. It went to a 20 for 1 stock split. You divide by 20, the new share is 100. But what didn't change? The revenue, the profit, the cash flow, and the balance sheet. Nothing fundamentally in the company changes. All they're doing now is instead of having 10 shares in a company, they now have 200. So if the company did $1,000 in revenue, split 10 ways, it was $100 a share in revenue. Now it's split 200 ways. So that's same $1,000. It is now split 200 ways. It's $5 a share. Guess what? It's still $1,000 in total revenue. Don't be the sucker who thinks that the stock is cheaper. So why then do companies split stocks? For exactly the reason that I just explained. Because all the suckers out there think it's cheaper. They can buy more shares. It makes them feel richer. Oh, I can buy 100 shares now instead of just 5. But it's not actually more money. It's still 100 shares at $5, which is 500. Sorry, it's still 100 more shares at $100 versus 5 shares at $2,000. It's still the same $10,000 investment. If you can learn this part, you are well on your way to becoming a great investor. Be the fool at the table who thinks they're getting more of the company. You're not. You're still getting the same amount of money deployed and the same percentage of the company. That is it. So again, if you're new to the channel, we're going to do our 8-pillar process right now on Google to see what you should pay for the company based on the actual fundamentals. So I go to stock search. I type in the good old Goog. All right. So here's the stock price on a split adjusted basis. It had a high of 150 and a low of 101. And it's currently sitting at 109. So a little bit above the low for the year. So pillar number 1, guys, we want the 5-year PE for the business to be below 22.5. So if you have our software already, follow along. You've been doing this 1,000 times. If you don't, stick along. You'll be able to figure out how to buy it later. The current 5-year PE is 35. So that's an X. Because remember, we want it to be under 22.5. Now, does that mean you immediately sell or avoid the company? Not necessarily. Remember, PE should be reflective of growth potential and moat. And I think Google has both. So you should be willing to pay a higher premium than other companies. Does that mean any price is good? No. We're going to use a stock analyzer tool later to figure out exactly what we should pay for the company based on assumptions. Pillar number 2, we want a 5-year return on invested capital greater than 9%. So again, on our software main page, right here, the 5-year return on invested capital is 13.6. Check mark. Another reason to pay a premium for the company, a high return on capital. This means they take the money that's invested in the business and they get a high rate of return on it. Pillar number 3, we want simply revenue growth. So we go to the income statement. And 5 years ago, they did $123 billion. Last year, $270. Over double. Check mark there. Pillar number 4, we want net income growth. So we scroll down just a little bit more on the software, on the income statement. 5 years ago, 16.6. Guys, $75 billion last year in profit, almost 5 times more money. That is incredible. This is why you should be willing to pay a little bit more for Google as a multiple. Pillar number 5. Now, guys, this is the hidden secret of investing. This is the silent killer for those who don't know it. Shares outstanding. When it comes to shares outstanding, companies that issue shares are diluting their owners. And this is not to be confused with a stock split, where if you own a share, you get more shares. When a company is diluting owners by issuing more shares to raise capital, you still own the same number of shares, but the total number of shares increases. So you're now splitting up the profit, revenue, cash flow of the business into more shares than your own shares. And that sucks. It's a silent killer. For example, if a company grows by 50%, but they also issue 50% more shares, you've gained nothing. You've gained absolutely nothing if the revenue and profit has increased 50%, but the share count has also increased 50%. Think about that. So what do? We go to the bottom of the income statement. We go to the end of year 6, 13.83 billion shares, and now 13.2. Check mark there. So they are buying back shares. Pillar number 6 has to do with long-term liabilities. Debt works for a company the same way debt works for a person. If you and your neighbor have everything the same income, same house, same car, same family, everything, but you have $10 million in debt and they have 0. Or other way around, they have $10 million in debt, you have 0. Who's more likely to survive downtimes? Of course, the one with less debt. So same thing here. So what do? We go back to the main metric page. We look at the 5-year average free cash flow labeled right here. We multiply that by 5. It's roughly $195 billion, 39 billion times 5. So we want the long-term liabilities, the long-term debt of the business to be under 195 billion. So we go to the balance sheet. We scroll all the way to the bottom, and the long-term liabilities right here. Total long-term liabilities, $41 billion. Guys, this company has such little debt, it's incredible. In fact, look at this. Their total cash on hand, which is total current assets, is 178 billion. Their total liabilities are 103 billion. They have plenty of cash on hand to pay off all debts of the company. Think about that. That's incredible. Now, finally, pillars 7 and 8 have to do with free cash flow. Guys, free cash flow is cash from operations less your capital expenditures. And there are 5 things we can do with free cash flow. We can buy back shares, pay down debt, pay dividends, invest back in yourself, and make acquisitions. You can do any combination of those, none of those, all of them doesn't matter. On the cash flow statement in our software, we have added a line to make the math easy for you. Free cash flow, cash from operations less the capital expenditures. 5 years ago was 21.2. Last year, 69 billion, over triple. Check mark there. In our final metric, we want to treat like PE ratio, but it's the price to free cash flow ratio. And just like PE, we want the 5-year PE to be under 22.5, but we don't have it listed, so we have to do a little bit backwards. We take the free cash flow of 39 billion, call it 40 billion. We multiply it by 22.5, and we get $900 billion. So we want the market cap of Google to be under 900 billion. So we go back to the main page, the metrics page. The market cap is 1.44 trillion. So that is an X. Now there was a lot of math here, but we made the software easy for you. You can skip right to the 8 pillars tab right here, and it tells you all the data. And remember, 2 X's right here. And they're both valuations, PE and price to free cash for the last 5 years. Everything else is a check mark. So your next question should be, what should I pay for the stock? Well, every investment is the present value of all future cash flow. Now, we don't know the future. Our job is to make assumptions about the future, and this is part of the art of investing. Your assumptions will be different than mine. No better, no worse. It's just assumptions based on our research. So we created a stock analyzer tool because what it does is it takes those assumptions and tells you what you should pay today for the stock based on those assumptions. So let's go do that right now. First thing I'm going to do is I'm going to do a 10-year analysis because I believe Google will be around for a long time. So let's do 10 years. Now, it's going to tell me my revenue growth numbers over the last 10 years. 1, 5, and 10-year numbers. Now, remember, guys, a lot of people will say that value investors don't care about growth. Growth is the most important part of, in my opinion, of value investing. Because what happens is people will overpay for growth. We just want to pay a reasonable price for growth. That is why the stock analyzer tool is so valuable. So I'm going to make some assumptions. Now, 21% revenue growth is probably not sustainable for the next 10 years. My goal is to be conservative. So I'm going to go with 7, 10, and 13% revenue growth is my low, middle, and high. Now, profit margin will probably stay pretty close to the same numbers. So I look at this and I'm going to go with 21, 22.5, and 24. Maybe kick out of the park, and this profit margin from last year continues to drive up the numbers. Free cash flow margin. They look pretty similar, so I'm going to keep the same numbers as profit margin. Now for PE, guys, this is where we're going to get into disagreements. The 1-year PE and the 1-year price of free cash flow are around 20. Google should justify a higher PE, but the historical PE is 15 for the entire stock market. So what's my goal here? I'm going to sit here and say 14, 16, and 18 for my low, middle, and high. And finally, for my desired annual return, I'm going to go with 12.5%. So why 12.5%? Well, you can invest in an ETF and get 9 or 10%. So in order to get some sort of margin of safety, which value investors want, as well as to buy an individual stock, give yourself 12.5%. Some stocks I do 15%, some 20%. It just depends on how uncertain the future is. But I think with Google, it's a lot easier to understand it. So I hit the analyze button, and the current price is 109.50, and it's telling me pay a low price of 70, a high price of 140, and the middle range is about 100. So we're pretty close to the middle. Now, does this mean go out and buy the company the second it hits 100? No, but here's what we can do. We can add it to our watch list on our software and notify me when it goes below 98.57, or you can change this price to 100. Change it to 100, notify me. Now, what you should do then is start doing your research now so that when it hits 100 and you can verify that it actually is worth 100 to you, you buy it. But you need to do a little more research. That's why the community is so important. Because research is agonizing. I hate research. You probably hate research. But over 12,000 people have signed up for the software, and there are thousands in the community who are active every single day. Go engage in them. You can look up Google in the community and see where they're talking about it. Show your ideas. That way they can share their ideas, the bull story, the bear story, and you can get a better understanding of the company. If you like this video, I want you to do 2 things for me. First off, subscribe to the channel. Secondly, go watch this video on the 8-pillar process and how it can help you out in the future. Thank you very much.